For those of you who are familiar with our residential economic report, this is our opportunity risk section. This gets a little bit busy. So I'm just going to briefly move from left to right. The housing demand we've talked to a little bit in some of the earlier slides. This is driven primarily by employment, by oscillations in employment. When the employment market is good, there's demand for more housing. When the employment opportunities are poor, we're having a recession and we're losing jobs, this number moves down. And it oscillates fairly significantly, unlike the next number, housing supply, which tends to build very slowly. This market is no different than most markets across the country. It's difficult to acquire and entitle land. It's difficult to get permits and financing and develop a suitable product platform and deal with the neighbors and so on and so forth. So the supply grows very slowly, whereas the demand tends to oscillate to a much greater degree tied with the employment market. Year over year, you can see whether the market is overbuilt or underbuilt in any given year. And again, it's really not a function of what's been constructed, because the supply grows in such a measured fashion. It's really a measurement of how the job market's performing. So we're presently overbuilt fairly significantly on the basis of these large job losses that we've experienced from 2008 to 2010. Moving over, median home price, you can see the peak, the annual percentage change. We suffered a couple of years down, but we've got nominal 1.7, very small, maybe hard to observe in your neighborhood, definitely varying from market to market, submarket to submarket, but we've got a little bit of appreciation, which we saw in an earlier slide in 2009 and in 2010. Equilibrium home price, we can see that in the middle of the graph. Those numbers are lower than they were in 2008, but you get a big increase or decrease actually, a big increase in affordability, decrease in mortgage rates, and we get a big improvement in the equilibrium home price in 2009. It goes from 241 in 08 to 272 in 09, as a function of what that 60,000 plus income can support at a 5.04 interest rate versus a 6.04. That 100 basis points is the difference in that equilibrium home price. You can see household income, that's self-explanatory. Then we get into the over and undervalued, and as we've said earlier, based on current incomes, long-standing household incomes that don't tend to change that dramatically, and current rates, this market is substantially undervalued compared to the historical norm. It's just simply not being recognized on the ground due to the magnitude of the recession, the lack of confidence, the daily news where everybody hears about layoffs and all the problems that are in the economy. If you put that to an equilibrium number, you can see that on the right. Underneath 98 is considered weak, over 98 stable. You start to get into about 102, 103, and you're into strong market conditions. On the far right is the market health in 24 months. So if you look at 2007, you could see the market was starting to show signs of stabilization and moving towards improvement, which we did in fact see on the ground in 2009. Coming forward to 2010, we've got still better conditions, and affordability remains good, rates remain low, and the distressed inventory is not so giant that it's overwhelming the market in most areas. Now, going out a few years, we have generally stable conditions before we start to get a little bit overvalued at the end of the projection period in 2014. We've talked about in a couple of slides that we don't just have price improvement on the ground, which we could see in the resales and some of the graphs and charts earlier, but we also have market improvement moving its way through the food chain. Now, when I first showed this slide about 4 or 5 months ago, this is 2x4 lumber traded on the Chicago Mercantile Exchange. Contract is 110,000 board feet. These prices on the right, 300, 200, those are price per thousand board feet. When we first looked at this contract, looking for signs of improvement, the price was underneath $200. It was 180, 190. Now it's moved up through 300, through 320, up to 340. Looking a little toppy here, but still, the price improvement here has been significant. There's very little reason why, as a builder or even a manufacturer of engineered wood products, why you would buy this lumber and take control of one of these contracts, one of these futures contracts, unless you actually needed the lumber. You don't want to let it sit outside. There's hedging involved, absolutely, but most of this is expected to be delivered in the spring months, so it can go into construction in the good weather of the summer months, and it can go into manufacturing that goes into construction in the summer months. So this is an improving supply chain on the lumber side that's really gone over about a 4 or 5 or 6 month period, reversing really a brutal downtrend that took place in 2008 and 2009. One of my parallel slides that goes with the lumber slide is this is the publicly traded company Louisiana Pacific. Louisiana Pacific makes engineered wood products, and that would include OSB, oriented strand boards, subfloors, truss systems, different things like that. You could see in the time we've been watching this going back 4 or 5 months. This is a 3-month chart here. It was too big to show the time period. But 3 months ago, this particular stock was in the 5s and 6s, and it responded pretty quickly to new orders, to expectations of better earnings, and to higher demand coming through the food chain as manifest in orders to this company and potential revenues. Now you can see this ran from 6 to 12. We're a little bit concerned about not this company and its stock price, but what it means in terms of house costs on the ground. On the ground, these higher wood costs and higher costs for engineered products can add a couple of dollars to the house price, and we're hoping that this really doesn't get carried away and run too far. We think, if you look at the right side of this chart, we've seen a consolidation pattern coming in here. Who knows if those are the highs for the year, but either way, this ran a little too far, a little too fast, and hopefully is consolidating at a level that won't have house price or house cost run away on us at this point in time. You can look and see there's many other examples of this. Weyerhaeuser, different timber companies, that some of the other suppliers, Cemex, copper is also widely used, but none of them are quite as tightly correlated as lumber. One last thing on the lumber market, we've also seen the freight companies, the rail companies, Burlington Northern, Southern Pacific, these sorts of companies are all reporting much higher lumber shipments, up 100% from the bottom, and they're still only, 40 or 30% of what they were 2 or 3 years ago. So there's a huge improvement, but we're far below the levels of lumber shipments that we saw in 2006 and 2007.